Hey there, welcome back to the channel. Today's topic is one that has a lot of you scratching your heads: personal loans versus 401k loans. You've probably heard of both, but which one is actually a better option for borrowing money when you need it? Do you take the easy route and go for a personal loan? Or do you take the plunge and borrow from your retirement fund? Tough choice, right? Don't worry, we've got you covered. In today's video, we'll break down exactly what each option offers, the pros and cons, and, more importantly, what could happen if you make the wrong choice. Spoiler alert. You might want to stick around till the end, because things are going to get interesting. But before we dive in, make sure to hit that like button, subscribe to the channel, and ring that bell so you never miss our deep dives into personal finance topics. And of course, share this with anyone who's struggling with the decision of taking out a loan. They'll thank you later, trust me. All right, let's start with personal loans. What are they exactly? Well, in simple terms, a personal loan is an unsecured loan that you can take from a bank, credit union, or even an online lender. And when I say unsecured, I mean there's no collateral. So if you don't pay it back, they can't come after your stuff, like your car or your house. However, they do have the power to come after your credit score, which, let's be honest, is a pretty big deal. Now, personal loans usually come with a fixed interest rate, which means you're going to pay the same amount of interest every month until the loan is paid off. Pretty straightforward, right? You borrow, you repay, and you move on. But wait, there's more. Personal loans are versatile. You can use them for almost anything: debt consolidation, home renovations, medical bills, or even that dream vacation you've been eyeing. Though, pro tip, vacation loans might not be the best idea unless you plan to spend your time sunbathing and not paying interest. Now, let's talk numbers. Typically, personal loans can range from $1,000 to $50,000 depending on your credit worthiness, and you'll usually get between 2 and 5 years to pay it off. Sounds pretty good, right? Okay, now let's talk about 401k loans. So imagine you have a nice chunk of money sitting in your retirement account and you're like, hey, why not borrow some of it for a rainy day? Well, that's where the 401k loan comes into play. But here's the catch. You're borrowing your own money. Yes, your own money. Sounds pretty sweet, right? It's like you're taking a loan from your future self, except you'll have to pay it back with interest. But here's where things get interesting. The interest you pay? Well, that goes back into your 401k. So, technically, you're paying interest to yourself. Is that brilliant or just a sneaky way for your 401k to grow even faster? I'll leave that for you to decide, but, and this is the important part, you can only borrow up to 50% of your 401k balance, or $50,000, whichever is less. So if you've got a smaller balance, well, you're not getting $1 million loan from your 401k. Also, you're usually required to repay the loan within 5 years if it's for something like a home purchase. And that's something to keep in mind. You have a timeline to pay it back. If you fail to do so, that loan is considered a withdrawal, and the IRS will come knocking for the taxes and penalties. Now you're probably wondering, what's the real difference between these two? Why should you pick one over the other? Well, let's break it down. First off, with a personal loan, you're dealing with an outside lender, whether it's a bank, credit union, or online lender. That means you'll pay interest to someone else, and you're subject to their credit requirements, which could be high if your credit isn't great. Meanwhile, a 401k loan? You're borrowing from yourself. It's a loan with no credit check. You can take it out even if your credit score is as high as a paper plane. And you only pay yourself back, no middleman. But here's the kicker: interest rates. For a personal loan, your interest rate will vary depending on your credit score, income, and the lender. It could be as low as 6%, but if your credit is less than perfect, expect rates as high as 36%. Yikes! On the other hand, a 401k loan typically has a low interest rate, often between 5 and 8%. And like I said, that interest is paid back to your account. Sounds like a win-win, right? All right, let's go over the pros and cons of a personal loan. First, the good stuff. You get that cash up front and you can use it for pretty much anything. Plus, you don't have to touch your retirement savings, which is always a win. The downside? Well, there's interest, and depending on your credit score, it can be pretty high. Also, if you miss payments, your credit can take a serious hit. So overall, a personal loan is perfect if you need quick cash, and you're confident you can repay it in time. Just be prepared for the interest and make sure you can handle the monthly payments. Now let's look at the 401k loan. The big pro here is the low interest rates and the fact that you're borrowing from yourself. No credit checks, and that interest goes back into your retirement account. It can feel like a smart move if you need money fast, but there are some serious risks to consider. First, if you leave your job before the loan is repaid, the entire loan balance could be due in full within a short time frame. If you can't pay, the IRS will treat it as a withdrawal and slap you with penalties and taxes. Ouch! Second, and this is important, you're dipping into your retirement savings. That money could be earning compound interest while you're off using it for other things. So if you're borrowing to cover an emergency, make sure you really need it, and ask yourself if it's worth derailing your future retirement plans. So there you have it, personal loans versus 401k loans. Which one's better? It really depends on your situation. If you need fast cash with no strings attached and you've got a solid credit score, a personal loan might be the way to go. But if you're willing to take a calculated risk and you don't mind tapping into your future savings, a 401k loan could save you on interest rates. Now it's your turn. Let me know in the comments which option you would choose. Personal loan or 401k loan. And don't forget to share this video with anyone who might be thinking about borrowing money. It could save them a ton of headaches. Make sure to like, comment, and subscribe for more videos like this. Thanks for watching, and I'll see you in the next one. Stay smart with your money, everyone. Comment below, which loan would you choose? And share this video with a friend who needs to make this tough decision. It could save them big time.